Ability in trading does not emerge from constant action, it grows from deliberate restraint and disciplined decision-making. Many traders believe that being active, always entering new positions, reacting to every market movement, and constantly adjusting trades somehow equals skill. But this mindset is exactly what keeps most traders stuck in a cycle of inconsistency. The true turning point arrives when a trader realizes that the market does not reward activity, it rewards accuracy. The shift from needing to trade to waiting to trade is the first real sign that someone is stepping into consistent profitability. In the beginning, every flicker on the chart feels urgent. The trader thinks, if I'm not in a trade, I'm missing out. This fear of missing out creates an emotional attachment to market noise. Every small move looks like an opportunity. Every breakout feels promising. Every dip seems like a discount. But as the trader gains experience and, more importantly, scars, they begin to notice that most of those opportunities were nothing more than traps. The market was moving, yes, but not moving in a way that aligns with high probability setups or clear signals. They begin to see the cost of impatience. Eventually, there comes a moment when the trader sits in front of the screen, watches the market move, and feels no urgency to participate. That moment is powerful. Opportunities no longer dictate their actions, criteria do. Instead of looking for excuses to enter trades, they now search for reasons to stay out. They understand that being flat is a position, too often the best one. This mindset shift alone eliminates half of their previous losses. When a trader no longer needs constant action, they start to see the market with more clarity. They stop predicting and start observing. They recognize that the market does not move according to their opinions or desires, but according to supply, demand, momentum, and sentiment. They learn the value of letting a setup fully form rather than forcing one prematurely. A disciplined trader will watch a potential trade develop slowly, waiting for confirmation rather than guessing the outcome in advance. They know that a good trade should almost feel obvious, not forced. This discipline extends beyond patience and into the mechanics of the trade itself. The trader now understands that every position requires a reason to enter, a plan for risk, and a logical expectation of profit. They won't enter a trade simply because they've been sitting idle. They won't convince themselves that a mediocre setup is good enough. The emotional impulse that once pushed them to act has weakened, replaced by a calm understanding that the market will always offer another opportunity. There is no need to chase. The disciplined trader also becomes aware of how time plays a role in trading. They begin to recognize that high-quality setups do not appear every hour, and sometimes not even every day. Instead of panicking during slow periods, they use that time to prepare mentally, review past trades, refine their strategy, or simply rest. They start to appreciate the rhythm of the market. There are moments of aggression and moments of stillness, and both are essential. Trading during stillness often leads to unnecessary losses. Trading during aggression with clarity leads to strong gains. Finally, this discipline strengthens their emotional control. When they no longer feel the need to be constantly involved, they stop making impulsive decisions. They stop reacting to small price jumps, temporary volatility, or sudden spikes in emotion. They are no longer traders driven by fear or excitement. They become traders guided by probability and patience. This transformation, shifting from needing to trade to waiting to trade, is one of the strongest indicators that someone is stepping into consistent profitability. The path toward becoming a consistently profitable trader begins long before the trades improve. It begins inside the trader's mind. Charts, indicators, strategies, and patterns are tools, but they are powerless without the mindset to use them properly. The true evolution is psychological. A trader who is growing into consistency starts to understand that markets will always be uncertain, but their own reactions don't have to be. Emotional control becomes the foundation of every decision, whether in moments of profit or moments of loss. This is the point where trading stops being an emotional roller coaster and becomes a disciplined craft. One of the clearest signs of this internal growth is the way a trader responds to losing trades. In the early stages, losses feel personal. They trigger frustration, doubt, revenge trading, or impulsive decisions meant to get the money back. But as a trader matures, their relationship with losses transforms completely. A losing trade becomes nothing more than information feedback from the market. It is no longer a threat to their confidence or identity. They know that losses are an unavoidable part of the business, and they accept them with a calm, almost detached mindset. A loss does not lead to emotional spirals, it leads to learning. This emotional shift impacts how they view winning trades as well. Beginners often rush to lock in profits at the first sign of green because they fear losing what they've gained. But the maturing trader learns to stay steady even when a trade is working in their favor. Their goal isn't to feel good in the moment, it's to give the trade enough room to unfold. They understand that small wins are often the enemy of big wins, and that letting profits run is where real account growth comes from. This ability to hold a winning position even when the emotions want to interfere is one of the strongest signs of mental evolution. Another internal transformation occurs in the quality of their decision-making. The trader stops making choices based on hope or fear and starts making them based on logic, probability, and predefined rules. They no longer enter trades simply because the market looks like it might move. They no longer exit positions out of panic or uncertainty. Instead, every action is supported by a reason, a valid setup, a clear signal, a tested plan. Their thinking becomes structured. Their emotional impulses lose power. They become deliberate instead of reactive. This clarity also affects how they manage uncertainty. Instead of trying to predict the future, they focus on controlling risk in the present. They know that they cannot force the market to behave a certain way, but they can control how much they are willing to lose. They can control their entries and exits. They can control their discipline, their routine, their preparation. This shift from trying to control the market to controlling themselves marks a huge leap in psychological maturity. They also begin to detach from the need for constant reassurance. They stop checking their trades every few seconds. They stop panicking during normal fluctuations. They are no longer glued to the screen with tension. Their confidence grows because they trust their process, not their emotions. They still feel fear and excitement, but those emotions no longer determine their decisions. Their system does. Over time, this new mindset creates a sense of calm even during volatile market conditions. The trader becomes aware of their own tendencies and corrects them in real time. They recognize impulsive thoughts before acting on them. They recognize emotional triggers and neutralize them. They recognize when they are tired, distracted, or not in the right mental state, and they choose discipline over temptation. This is the inner work that most traders never do. But once it begins, the signs are unmistakable: emotional control strengthens, clarity replaces hope, and decisions become deliberate rather than reactive. This psychological transformation is what